watching Stockwatch. I'm Simon Brown. Joining me to unpack your stock-related questions today, Rowan Williams from Nitrogen Fund Managers, Alex Duys from Umthombo Wealth. Be sure to send your questions through email, stockwatch@bdtv.co.za, SMS 41392, or on Twitter @BusinessDayTV using hashtag Stockwatch. Gentlemen, appreciate the time. Rowan, wild markets out there. We might yet still close green. Is the bigger issue, and watching US futures markets, and I appreciate, I don't know who's trading futures at 2 o'clock on a Monday morning in the US. Is this perhaps more than anything, even if it gets walked back by Trump or victory claimed or something, it almost becomes a confidence game, and confidence perhaps is being lost?
Certainly, yeah. I think investors' metal's been tested here. If you look at the numbers, the stats have been bounded about that this is one of the worst market pullbacks in 30 years. And I think what has happened is we knew there was going to be a degree of uncertainty with the Trump presidency, but this just ratchets it up. So I think, as you're pointing out, a lot of the drawdowns are not necessarily driven by the fundamentals, but a change in people's risk sentiment, risk appetite, and just what sort of discount rates do we need to put in this environment. Uncertainty's gone up. It's at a premium. We also have to look at the levels at which we went into this, the US market at record highs. So certainly a lot of repricing that still can take place. I think what is starting to happen is people are looking maybe a little bit more discriminately. The South African market is incredibly cheap. Didn't come into this rally or market environment with super high valuations or multiples. So people are starting to look for bargains, and I think where the chips will fall may differ globally. But certainly, yeah, it's a crazy time.
Alex, it is about certainty, and I like also the point around valuations. And I'm not sure that US markets broadly, and of course there's pockets of it, are necessarily cheap yet, considering the valuations which they were at their peak a couple of months back.
Yes, agreed. So I think it has to be looked in context. First of all, the valuations were very high for a number of years now, and specifically start of the year. And everyone has highlighted that the US market is, it probably won't be able to sustain or at best keep at these levels while it grows into its valuation. So any sort of shock like we're seeing now is causing a panic, and obviously the fall off is much more than would have been if it was trading at, call it, normal valuations. I think it's really started pretty much when the AI battle started to make comments that the Chinese are going to compete. I think that was the sell-off in the MAX 7. Now, obviously, what we're seeing here is further increase the risk premium. And I agree with Rowan that it makes it quite interesting from a relative perspective to other countries. Like South Africa, emerging markets underperformed now for, 15 years. And our valuations are looking very compelling. But of course, you need some form of change in sentiment to capital come to these markets. But at some stage, that will happen. So yes, I think it's looking quite interesting. You shouldn't be, the market sells off like it is in the moment. It obviously creates a little bit of fear, but also some excitement because you can pick up some very good opportunities and specifically increase your quality of your portfolio. So if some quality stocks do sell off, you get opportunity to buy them at reasonable valuations.
Yeah, and we've got some questions coming through around what I would think are quality. Alex, stay with you. Question came through over the weekend. Looking for some nice defensive tobacco companies. Philip Morris, British American Tobacco. Either, neither. Is there a preference between, or both just too sort of old school?
Yeah, for me, British American Tobacco is obviously not a relatively attractive valuation, and moving into the NGOs, which is the new generation products. But Philip Morris got a clear leader there. So if you believe in that narrative, probably be better to invest in Philip Morris. BATS, of course, is cheaper, but for reasons as well. And you do have perhaps too much exposure to the US, and we know that, of course, regulatory environment in the US is not particularly pro-tobacco. So there are some longer-term issues, I would say, with BATS, but you can certainly make investment case short to medium term. And if you do want to hold tobacco medium to long term, my preference would be for PMI.
Rowan, Philip Morris, British American Tobacco?
Yeah, no, I'd agree with Alex. I think what is important in the portfolio is the exposure to those new generation products, because that is where the I guess the younger consumer is looking, the non-combustibles, and that Swedish Match acquisition was incredible. I mean, you see all these youngsters around with Zyn pouches in their mouth. So that's a lot more defensive, I think, for the medium term. I think smoking will continue to come under pressure, traditional smoking. And one of the points was, getting quality at a reasonable price. So stocks that are good for the long term and at a better valuation, that's an interesting point, a place to put them on here when you get an opportunity to buy.
The follow-up from them, from the question asker as well, Rowan, next day with you a minute. Anheuser-Busch, AB InBev, I mean, there's opportunity there, although they're, of course, getting competition from just the youth not drinking and drinking different, moving away from beer.
Yes, that's right. So there's quite a few interesting secular trends, and it does seem the youth of today are less interested in alcohol, and it's something of a trend. You hear things, something like zebra crossing, where they have one alcoholic drink and one non-alcoholic drink when they go out. So I would be somewhat concerned about those trends. I think beer, and other alcoholic beverages are here to stay. We know the hard liquor stocks have done particularly badly, actually. So it probably is more defensive as a sort of refreshment as well. So, but I would be concerned. I'd probably look elsewhere for consumer trends that are positive and reinforcing the sort of the product as opposed to a headwind.
Yeah, Alex, Anheuser-Busch.
Yeah, so that type of development, I think, is not something new. I mean, you can see that also, of course, in tobacco.
Yeah,
you smell it over there using their generation. Call it traditional gambling at casinos. The youth uses less traditional media, for example. So this is something that does happen. That's how business cycles work. In the case of alcohol, I think a good argument can be made for that the consumption is going to remain lower going forward. But Anheuser-Busch do have obviously incredible economies of scale, and they can obviously boost further their gross margins over time, and they can do share buybacks, and they can extend the duration, not much longer than you anticipate, like the tobacco companies have done. People have been saying 20 years ago tobacco is going to go bust, but they're still here. So I think that they can still got levers to pull, but yes, it's not necessarily as exciting as other new trends that Rowan is referring to.
Yeah, take your point on that. Question coming through around Capitec. It came through earlier this morning when Capitec was, I think, under 2,500. It bounced quite markedly since then. Alex, opportunity in Capitec?
Yeah, so Capitec are one of those stocks that I referred to when I say you can perhaps buy quality stocks at a better price. And that's the one I'm looking out for, is Capitec. I'm not yet at the levels where I'm pulling the trigger, but I'm certainly having a very close look at it. So if there's another 10 or so % downside in Capitec, I'll certainly will be interested in it. I think the overall structural growth story is still there. They've got a change of management, but it seems like a logical choice has been made there. So yes, look out for businesses like Capitec. Look out for similar type of businesses overseas where they sell off 20, 30, 40%. Could be a great buy opportunity.
Rowan, Capitec?
Yeah, it's certainly been one of the major success stories. It is heavily held by foreigners, and I think that's one of the reasons that you've seen the sell-off. But I guess at the same time, you are seeing quite a lot of stock resilience, which shows you there are a lot of pundits and investors looking at it and looking for the downturn, so it doesn't get as low as you would hope to get to the entry point. I mean, it's a mixture of a bank and a fintech stock, so with very exciting growth prospects, and I think that has still got a lot of runway. So you could have almost bought it at any price. So I guess it could be interesting on any pullback, and it is worth a very close look at.
Rowan, next day with you. Question coming through about 91. I hadn't looked in the chart in a bit. It's not, what's that, 5-year lows? Is 91 offering opportunity at these levels, or is it something we should be staying away from looking at the recent price action?
Yeah, so it has been a somewhat a conundrum, quite disappointing. I mean, until recently, markets were at all-time highs, and there should have been strong tailwinds there. So the fact that the share price was low is quite. Execution has, and I think that losing some market share. There's pressure on margin. So I think asset managers sort of at this level heavily geared to the market may be interesting, Coronation, for example, but we haven't preferred 91 just because of their business execution. But I guess if it's at 5-year lows and you think the market can move up from here, it may be interesting. But again, we think there may be sort of better ways to play it with other stocks.
Yeah, and you mentioned Coronation. It's also come under some pressure in the last little bit. Alex, 91 for you?
Yes, as Ryan says, it's a geared play either to the up or the down cycle. So if you do believe that there's going to be recovery in markets, I would say it makes sense to consider something like a 91. Also, a couple of other themes. So if you look at the last few years, a lot of money has flown into passive, specifically in buying in Magnificent Seven in the US.
Mm-hmm.
And that has come at the expense of pretty much all other markets, specific emerging markets. So we do see a change in trend from away from passive or specifically Magnificent Seven to Europe or emerging markets specifically. I think 91 will be very highly geared to that. So I think that they're well positioned there because asset allocators have pretty much ignored them over the last couple of years. You've seen the net outflows. So if you do see a change in net flows combined with in some of the markets, it's highly geared. And business has got also no risk of going bust. I mean, they've got a lot of cash. They're doing share buybacks at the moment. They pay a good dividend. They've got an excellent management team as well as investment team. That management team has created alpha before, and markets like this anticipate to create alpha again. So yes, I think it's one you have to buy at its perceived cyclical lows, and then try to hold through a cycle to make abnormal returns if you're right on your timing.
Yeah. Question coming through around gold. Expecting gold to do better in these tough times. Has it perhaps just run too hard? Is there still opportunity in gold or perhaps gold miners? I mean, Alex, we see this when things collapse. I mean, it's almost like correlations all go to one because it's just around liquidity. Gold at these levels trading around 3,050 or perhaps a gold miner?
Yeah, so you're pretty much correct. Everyone is just like trying to create some liquidity. Even gold has got sold off in this recent route. So gold does have a lot of tailwinds. There's no doubt about it. We know that Asian, specifically China, continues to buy a lot of gold, and with the uncertainty now being created with Trump tariffs, you probably would expect demand to remain there. But saying that, every time in the past when I felt like I wanted to capitulate and buy gold, it gives you a sense that we're probably at the top of the cycles. So I'm not too sure if we're there yet. But it does feel to me too much of a consensus trade to some extent. That gives me some concern. On the positive, if you do believe gold will remain, these prices will go higher, I think the gold stocks does not reflect that. There's probably more upside to those particular businesses. So depends on your view. If you like gold, probably buy gold stocks with gold. If not, be cautious.
Rowan, gold, either the metal, I mean, to Alex's point, it's a very crowded trade, and that does sometimes bother me. But then there is also, central banks uncertainty. Would you be looking at gold or gold miners with the metal just above 3,000?
I think to some extent, if you're prescient enough to have held gold into this, you've done incredibly well. And I think this is the reason you were holding it, because of this high degree of uncertainty and very sort of adverse geopolitical events which have taken place. So I think you've actually achieved your objective here. And if you held it as a sort of currency and you've got it, now you want to use that currency. So I actually think it's a reasonable time to be rotating out of gold and looking for those quality stock picks where you're actually buying underlying businesses, notwithstanding, the sort of maybe depressed economic growth in the short term, that will continue to do well and attract customers and generate higher returns on capital. So I think you can actually do quite well realizing the gains that you've made and deploying them into cheaper equities here.
Oh, okay, I like that thinking. You've held gold, so you've kind of achieved your target. Now use those gains to go somewhere. Rowan, next I'll stay with you. Reunert, which fun fact was founded in 1888. I just seem to always remember that random fact. They've obviously got the cable business. They've got an ICT business as well. The stock's off a fair bit. Would it be one on your watch list at this point?
Yeah, certainly. I think we like it. I think the medium-term demand drivers are very much intact. European defense spending is on the up. They have some exposure to that. That's obviously got nothing to do with US tariffs. The cable demand should improve. We saw Eskom on Friday indicating that they're going to continue to roll out the transmission network, so there's sort of multi-year demand there. They do have some exports in the electronic components business to the US, and I think that's what's really spooked the market. We're actually trying to get color on that as to whether some of those may be exempt from tariffs. There was a 36-page list of exemptions of exports, and they may be on that. So I think it does look very interesting. It's down significantly. The P's single digits, high dividend yield, and I think good runway for earnings growth for the next 5 years.
Alex, Reunert?
Yes, I can go 100% there with Rowan. So if you look at the electric cable demand, I think it's still at levels below 2009 or 10. So the capacity in the manufacturing is still well below where it needs to be. So we'll get that benefit over time as the demand picks up. And as Rowan says, it's going to be multi-years. I mean, with the build of the new transmission lines, and that allows us obviously to put some of these new power stations onto the grid. That's a multi-decade year, well, not multi-decade, but certainly multi-years of type of pipeline. The ICT side, I think, are struggling. They are consolidating a little bit there, but there was once-offs in the last year, specifically some port issues they had. So that should come a little bit through as well. And defense, as Rowan says, got excellent prospects. We've got this issue of tariffs we need to find out, but other than that, I think the business is well positioned to give earnings growth of it, in our view, easily high single digits, if not double digits, going forward on very attractive valuations.
Alex, to stay with you. I think it was last week or perhaps it was the week before we were chatting Johnson & Johnson. Question came through. What about the concern of lawsuits that come from time to time? The most recent one has been on talc powder. Is that something to worry about, or is that just a cost of business? They are sitting on some 20 billion cash and cash equivalents. I mean, certainly they lost a case. I think it was actually a week before last, and the stock got hit a fair bit. But I mean, it just frankly it put the dividend yield up to 3.25.
Yeah, so that is the key biggest risk with Johnson & Johnson. You've got an unquantifiable potential claim. It could mean knowing American law and so forth. This could be enormous, right? So Johnson & Johnson has tried to shift into different companies, and now those companies are dormant or liquidated to see if that's going to be approved and so forth. So we'll have to wait and see. That is a particular risk, but if it is managed, accordingly, then buying Johnson & Johnson is valuation probably reasonable. I mean, I think the business prospects are still, I think, single-digit type of growth rates in dollars, revenue and earnings, but you've got this, call it J-curve type of risk that you don't know where it's going to pan out. So I like it. I hold it personally, but I understand there are risks with this, and you need to manage that in your overall position if you do have Johnson & Johnson in your portfolio.
Yeah, and I hold it. I mean, 68 years, I just Googled it, 68 years of dividends increasing. Rowan, Johnson & Johnson?
Yeah, I think most of the points are covered. It's one of these sort of bellwether, broad-based healthcare consumer stocks. So you're getting sort of very defensive positioning. You have to look at the sort of, the contingent liabilities and understand those. And I think as long as you can sort of quantify them and you feel the market's over discounting them, which is often the case, and they do manage to settle them at a reasonable valuation or amount, and then the sort of the overhang unlocks itself, and you sort of get an immediate increase. So as long as you've got enough downside protection, I think it's certainly one to consider. Again, quality stock that may prove to be a good entry point around these levels.
A question that came through early this morning, and I stressed early this morning because markets were down some 5%, and then PGM started to run. PGM's running off the lows of this morning. Is the bottom in? Is it time to buy? Rowan, I am not brave enough to call either of those two statements. Maybe you are.
Yeah, look, PGMs, they seem to carry a lot of sentiment, and people sort of either, divisive, love them or hate them. So I think what you've got to look at is sort of what is going to be the impact on auto demand and the end use of auto catalysts. We know there's sort of flip-flopping around the sort of adoption of EVs, and if that's going to slow down, it's better for auto catalysts and traditional combustion vehicles. So I personally am not that bullish on the demand for platinum and the growth of that. And we've seen the sort of sentiment and how it whipsaws the shares around. So, again, I agree. It's not for the faint-hearted, but not for me either.
Alex, I just picked up Anglo Platinum just as 1 to 1. And I got to say, when you zoom out in a 5-year chart, you can't see that 6% move today. Are you calling a bottom in PGMs yet, or are you going to wait and see more evidence?
That's difficult. I mean, if you look at the breakdown of PGM basket, dominantly, obviously, platinum, palladium, and rhodium. The previous bull cycle, it was rhodium and palladium that was on a tier way. And platinum has been going sideways for a number of years, right? So, and after such a bubble in rhodium, it's very difficult to see how you're going to have a quick recovery again in there. It did jump a little bit over the last couple of weeks, but predominantly, as I understand, is one specific OEM that was looking for rhodium, but I'm not too sure if there's sustained demand for it yet. But if there is, then potentially, yes, rhodium could look interesting, but I don't know. For me, there's not enough. We look at a few indicators internally, and we haven't seen enough of that turn yet for us to start getting bullish on PGM. So we're a bit more cautious. We used to prefer Amplats, but with Amplats pretty much giving away all their net cash to AGL, that gives away their buffer for the downtime. So, yeah, we're a bit unsure how to really tackle the PGMs at the moment. It's not one that's high on our priority list.
Yeah, I mean, and Anglo, 17 billion, thank you for playing, in leaving Anglo Platinum with, no balance sheet to speak of. Alex, question coming through, Hideko or Invicta, looking cheap, but perhaps tough times ahead justify the cheapness. Would you be looking at either Hideko or Invicta?
Yeah, so these are, very good businesses that obviously are a function of economic growth in the particular countries. So let's focus on Hideko. So, I think one of risky is that obviously predominantly the importer and then distributor of the products. So with all the tariffs happening, there could be ramifications for them. So that's something to really understand. But other than that, they keep on doing bolt-on acquisitions like they're doing locally.
Yeah.
And if SA GDP can get to 1.5%, 2%, they should be well positioned to really grow the business, double-digit earnings, very good cash flows, attractive valuation, good management. So we do like Hideko, we call it under normal circumstances. And Victor's got a bit more global businesses. They do believe that they can circumvent some of the tariffs through Singapore and so forth. I'm not too sure that is going to be the case. Obviously, you've got tariffs all over the case now, because at that stage was just on China. But I think it's a lesser quality business, Victor, compared to Hideko, but still offers attractive valuation, good management there, and Joffrey focus on cash, and they got multiple levers they can. So we find both reasonably interesting, but a preference for Hideko.
Okay. Rowan, we'll get your take on those next time because we need to go to stock picks. You're coming with Pick n Pay.
Yes, so we look at companies that are not really exposed to the sort of tariff tumult, and their key asset is Boxer, which they still own 65% of, and the share price is significantly lower than prior to the Boxer listing. The Boxer listing has done very well. The business continues to do well, very well positioned. So by buying Pick n Pay, you get access to the Boxer investment story plus optionality around the Pick n Pay turnaround. And really, we think that can gain a lot of traction. And as a basket, it looks attractive that you get both the irons in the fire when you buy Pick n Pay.
Yeah, and Boxer mostly over $10 above that listing price. So to your point, Pick n Pay disconnecting from it. Alex, you're taking to the sidelines for now.
Yeah, so I think it's difficult for me because I do see a lot of opportunities, specifically locally. Looking at some of the bank valuations, for example, they look very compelling. But I do feel like the sentiment is still quite negative at the moment, locally as well as offshore, and there could be further pullbacks. In such a case, then perhaps some dry powders would be quite handy, specifically to buy some of those quality stocks we referred to earlier. But if you do have some exciting opportunities in your portfolio, perhaps do some small top-ups. But in a way, I do still expect some downside, just because valuations were as high as it was in the US, and it's probably more downside. Yeah. So cash for now, but looking to employ soon.
Yeah, absolutely. The valuations have unwound, but not necessarily that much, and the uncertainty still ruling the waves. That's all for Stockwatch today. Thanks to our guests, Rowan Williams, Nitrogen Fund Managers, going with Pick n Pay, and by proxy some Boxer as well. Alex Duys from Umthombo Wealth, sitting on the sidelines, not too long, but staying there for now. Up next, the close. Stay watching.